What is fundamental analysis? Fundamental analysis is a method used by investors and traders to attempt to establish the intrinsic value of assets or businesses. To value these accurately, they'll rigorously study internal and external factors to determine whether the asset or business in question is overvalued or undervalued. Their conclusions can then help to better formulate a strategy that will be more likely to yield good returns. For instance, if you took an interest in a company, you might first study things like the company's earnings, balance sheets, financial statements, and cash flow to get a feel for its financial health. You might then zoom out of the organization to look at the market or industry it's operating in. Who are the competitors? What demographics is the company targeting? Is it expanding its reach? You could zoom out even further to take into account the economic considerations like interest rates and inflation, to name just a couple of factors. The above is what's known as a bottom-up approach. You start with a company you're interested in and work your way up to understand its place in the broader economy. But you could equally adopt a top-down approach where you narrow down your picks by first examining the bigger picture. The end goal with this type of analysis is to generate an expected share price and to compare it with the current price. If the number is higher than the current price, you might conclude that it's undervalued. If it's lower than the market price, then you could assume that it's presently overvalued. Armed with the data from your analysis, you can make informed decisions about whether to buy or sell that particular company's stock. Fundamental analysis FA versus technical analysis TA. Traders and investors new to the cryptocurrency, forex, or stock markets are often confused over which approach to take. Fundamental analysis and technical analysis stand in stark contrast and rely on significantly different methodologies to analyze different things. And yet, both provide data relevant to trading. So which one is best? In fact, it might make more sense to question what each brings to the table. In essence, fundamental analysts believe that stock price is not necessarily indicative of the stock's true value and ideology that underpins their investment decisions. Conversely, technical analysts believe that future price movement can be somewhat predicted from past price action and volume data. They don't concern themselves with studying external factors, preferring instead to focus on price charts, patterns, and trends in markets. They aim to identify deal points for entering and exiting positions. Proponents of the efficient market hypothesis (EMH) believe that it's impossible to consistently outperform the market with technical analysis (TA). The theory suggests that financial markets represent all known information about assets, that they are rational, and that they already take into account historical data. Weaker versions of the EMH do not discredit fundamental analysis, but stronger forms argue that it's impossible, even with rigorous research, to gain a competitive edge. Understandably, there is no objectively better strategy out of the pair, as both can present valuable insights into different areas. Some may lend themselves better to certain trading styles, and, in practice, many traders use a combination of both to observe the bigger picture. This is true for short-term trades as it is for long-term investments. Popular indicators in fundamental analysis. We don't look to candlesticks, MACD, or SI for insights in fundamental analysis. There are a handful of FA-specific indicators that are used instead. In this section, we'll discuss some of the most popular ones. Earnings per share (EPS). Earnings per share is an established measure of a company's profitability, telling us how much profit it makes for each outstanding share. It's calculated using the following formula: net income, preferred dividends, number of shares. Suppose that a company doesn't pay out dividends and its profit is $1 million. With 200,000 shares issued, the formula gives us an EPS of $5. The calculation is not a particularly complex one, but it can provide us with some insight into potential investments. Businesses with higher or growing EPS are typically more attractive to investors. Diluted earnings per share is favored by some, as it also takes into account factors that could increase the total number of shares. In the case of stock options, for example, employees are given the option to purchase company stock. Because this generally gives a higher number of shares to divide the net income, we would expect to see a lower value for diluted EPS versus simple EPS. As with all indicators, earnings per share should not be the sole metric used to value a prospective investment. That said, It's a handy tool when used alongside others. Price-to-earnings P/E ratio. The price-to-earnings ratio, or simply P/E ratio, values a business by comparing share price with its EPS. It's calculated with the following formula: share price earnings per share. ETs reuse the same company from the previous example, which had an EPS of $5. Let's say that each share trades at $10, which would give us a P/E ratio of 2. What does that mean? Well, it depends largely on what the rest of our research shows. Many use the price-to-earnings ratio to determine whether a stock is overvalued if the ratio is higher, or undervalued if the ratio is lower. It's a good idea to take the number into account by comparing it with the P/E ratio of similar businesses. Again, this rule doesn't always hold true, so it's best used alongside other quantitative and qualitative analysis techniques. Pros and cons of fundamental analysis. Pros of fundamental analysis. Fundamental analysis is a robust methodology for assessing businesses in a way that technical analysis simply cannot compete with. To investors worldwide, studying a range of qualitative and quantitative factors is a crucial starting point for any trade. Anyone can conduct fundamental analysis as it relies on tried and tested techniques and readily available business data. Or at least, this is the case in traditional markets. Indeed, if we look to cryptocurrency, still a small industry, data is not always available, and a heavy correlation between assets means that FA might not be as effective. Done correctly, it provides a foundation for identifying stocks currently undervalued and poised to appreciate over time. Top investors like Warren Buffett and Benjamin Graham have consistently demonstrated that rigorous research into businesses in this manner can yield tremendous results. Cons of fundamental analysis. It's easy to do fundamental analysis, but it's tougher to do good fundamental analysis. Determining the intrinsic value of a stock is a time-consuming process that requires a lot more work than just plugging numbers into a formula. Many factors need to be assessed, and the learning curve for doing so effectively can be steep. What's more, it's better suited to long-term trades than short-term ones. This type of analysis also overlooks powerful market forces and trends that technical analysis can identify. As economist John Maynard Keynes once said, "The market can stay irrational longer than you can remain solvent." Stocks that appear undervalued by every metric are not guaranteed to increase in value in the future. Closing thoughts. Fundamental analysis is an established practice that some of the most successful traders swear by. By refining a strategy, investors can not only learn to better estimate the true value of stocks and other assets, but also understand businesses and industries better as a whole. Combined with technical analysis, fundamental analysis can give traders and investors a well-rounded understanding of which assets and businesses it could profit from. Given the nascency of the crypto markets, however, you should understand that FA may not be as effective. Always do your own research and ensure that you have a solid risk management strategy in place.